Welcome to our deep dive. Today we're getting into something that, well, it affects pretty much everyone with any savings or investments. The psychology of investing.
Mm-hmm. It's crucial stuff.
Yeah, exactly. Our mission really is to unpack how emotions, fear, greed, how they so often seem to drive what the market does.
Right.
And more importantly, how you can maybe manage your own emotional responses. How you can stick to a smart investment plan. We're looking at some classics today, like Benjamin Graham's The Intelligent Investor and John Bogle's Common Sense on Mutual Funds.
Foundational text, definitely.
Okay, let's dive in.
So what's really fascinating, I think, is how Graham, in The Intelligent Investor, he paints this picture of the market. He describes it as like a huge pendulum.
A pendulum, how so?
Well, it's always swinging, right? Back and forth between what he calls unsustainable optimism. That's when stocks get way too expensive, and then it swings the other way to unjustified pessimism.
I mean, things get too cheap because everyone's scared.
Exactly.
Mm.
And Graham says the intelligent investor, the really smart one, is basically a realist.
Mhm.
They see this swing happening.
And they don't get caught up in it.
Right. They're disciplined enough to sell to the optimists, when prices are high, and then buy from the pessimists when things look bleak but are actually cheap.
That pendulum idea is really potent. It sounds so logical when you lay it out like that, but actually doing it.
That's the hard part.
Yeah. How do you stay realistic when, everyone around you is either totally euphoric or completely freaking out? It feels like standing still in a hurricane sometimes.
Mm-hmm.
Graham really cuts right to the chase, though. He has that famous line, doesn't he? Never buy a stock because it's gone up or sell one because it has gone down.
Classic advice. And Bogle says something very similar in Common Sense on mutual funds. He just puts it bluntly. Impulse is your enemy.
Impulse is your enemy.
Yeah.
Yeah.
Eliminate emotion from your investment program. Sounds simple.
It does sound simple, but I mean, be honest. How many of us haven't felt that urge, that itch to just do something when the market tanks, even when we sort of know better?
Oh, absolutely. And it's precisely that impulse, that human reaction that leads investors often to act against their own best long-term interests, even when they know the theory.
So the data backs this up.
Oh, clearly. It shows what Bogle called a consistently counterproductive investment pattern. Just look at mutual fund shareholders, for example. Their annual turnover rates, they went from about 8% back in the 1960s
Okay.
up to 31% more recently. Think about what that means for how long people hold things.
Right. The holding period must have shrunk.
Dramatically, from like 12 and a half years on average down to just over 3 years.
Wow. Less than 9 years at the time.
Yeah. And, it's not just individuals. Fund managers themselves contribute to this churn. Their average portfolio turnover, it went from maybe 17% historically up to 85% by 1997.
85% turnover.
Yeah.
That's almost the whole portfolio every year.
It's constant shuffling. And it's driven by those very emotions, the fear, the greed that Graham and Bogle were warning about.
Okay, so you mentioned this constant shuffling. You've highlighted the sheer cost of it. It's not just inefficient, right? What's the real hidden damage for an investor?
Well, it's enormous. You've got the transaction costs every time you buy or sell. And then there are the tax costs, often triggered by that short-term trading.
Graham talked about something similar, didn't he? A radical fallacy back in the 1920s during that new era investment boom. Does that connect here?
It absolutely connects. That radical fallacy he identified was this dangerous idea that a stock's quality, its desirability, somehow became entirely independent of its price.
So price didn't matter anymore. People just bought because it was going up.
Exactly. Pure speculation. People bought because others were buying, chasing momentum, completely detached from the actual value of the business. It sounds familiar, doesn't it?
Eerily familiar. But isn't there still an argument from, active managers that sometimes you need to make short-term moves, that you can outperform by being nimble?
That's the argument, sure, that they can outsmart the market. But honestly, the evidence, when you look at it over the long term, is just overwhelming. Bogle hammers this home.
What does the evidence show?
It shows that superior past performance is not predictive of future success. It just isn't. Most actively managed funds, especially after you account for their higher fees, consistently struggle to actually beat the simple market indexes.
So the fees are a killer.
They are. Bogle's insight here is so fundamental. Costs matter. It seems obvious, but the compound effect is huge.
Compound effect. Explain that.
Small differences in costs, year after year, they compound. They lead to, as Bogle put it, increasing and finally staggering differences in capital accumulation.
Staggering differences. Like how much?
Well, think about fund expenses, plus transaction costs from all that turnover we talked about, plus taxes, the combined impact. Bogle called it tyrannical. He showed examples where these costs could turn, say, a potential $1 million portfolio over 40 years into maybe only $230,000.
Wow. That's that's losing three-quarters of the potential growth just to costs and churn.
That is the tyranny.
Okay, so if the market is this pendulum and our impulses are working against us and costs are eating away returns, what's the path forward for you listening?
Well, Bogle's advice is it's incredibly simple, almost deceptively simple.
What is it?
He says, follow a simple plan and let the cycles of the market take their course. Don't try to time it. Don't chase fads. And then he adds, the secret of investing is, finally, that there is no secret.
No secret. That's kind of hard to accept, isn't it? Especially when you're constantly bombarded with hot tips and next big things. How do you actually embrace that simplicity? What stops people?
I think fundamentally it's our desire for control, for certainty. In a world that feels very uncertain, especially markets, we want to feel like we're doing something, like we're in charge. Believing there's no secret feels passive.
Yeah, it feels like you're not trying hard enough or something.
Right. But the real power, the thing that's often missed, comes from two incredibly simple, maybe boring factors: discipline and time.
Discipline and time.
Exactly. Bogle really emphasized this. Time is your friend. Give yourself all the time you can. It sounds passive, but it's actually your most active defense against those short-term impulses, against trying to time the market.
How does time help, specifically?
Because it lets compound interest work its magic, or as Bogle called it, its miracle. Your money starts making money, and then that money starts making more money.
That snowballs.
It snowballs, exactly. But it's exponential, like planting a seed, then its seeds grow faster, creating a whole forest. It starts slow, which is why people underestimate it. Bogle's advice: start investing early, even in your 20s.
Even small amounts.
Yes, even if it's just a small amount. And critically, never stop. Keep investing regularly, even when times are tough. That consistency builds the habit, keeps you in the game, and lets compounding do its work over decades. It's about consistency, not cleverness.
So wrapping this up, the big takeaway from this deep dive seems pretty clear. Your own emotions, your psychology.
Oh,
It can be your biggest help or your biggest hindrance when investing.
absolutely. Your worst enemy or your best friend.
Yeah. So understanding those market swings Graham talked about, the pendulum, embracing that, maybe radical simplicity, Bogle advocates.
Controlling costs aggressively.
Right, controlling costs, and maybe the hardest part, giving your investments the gift of time. That seems to be the way to navigate the pitfalls.
It's about setting yourself up to win the long game, not the short sprints.
Definitely food for thought. What really stands out to you from all this? How might you take these ideas about overcoming impulse and embracing patience and apply them to your own financial journey?